Investing can be tedious and utterly confusing, especially if you're a beginner investing in individual stocks. Most of us don't have the time to analyze our investments, and let's not forget, this includes time to buy, sell, and rebalance the portfolio almost regularly. Well, this is where index fund investing comes into play. Let's say you're in the process of planning your overall investment strategy and building a robust financial portfolio, but don't have the time and skills to manage and analyze the stock market. Well, in this case, you can try investing in index funds, which is a great strategy to make money for both new and seasoned investors alike. An index fund is an investment that tracks a market index, typically made up of stocks or bonds that attempt to earn the same return as a particular index. Considered a more simplified approach than its cousin actively managed funds, well, index funds can give you instant diversification and a passive way of investing in a broad array of industries with as little as a single fund. In this video today, we will have a comprehensive overview of index funds, giving you everything that you need to learn to decide why it's time to start investing in them. So what is an index fund? For beginners, you need to start with understanding what an index is. Well, an index is a measure of the performance of the price of stocks, bonds, or other tradable assets in the wider securities market. When you hear people talk about ups and downs of the S&P, they're talking about how well a specific index, the S&P 500, performed that day. An index fund tracks a particular benchmark index or specific financial market indices like the total stock market, the S&P 500 index fund, the Nasdaq Composite, or the Dow Jones Industrial Average, among others. An index fund buys the securities that make up an entire index, meaning you can buy a single share of an index fund and get instant exposure to a ton of industries. So it could be said that there's an indirect way to buy the whole market. For example, if the index tracks the Standard & Poor's 500, an index of 500 of the largest companies in the United States, the fund buys shares from every company listed on the index. You, as an investor in turn, will buy shares from the fund whose value will mirror the gains and losses of the index being tracked. Besides tracking a particular stock market index funds can also be created to track a particular sector like technology or healthcare. Investing in an index fund typically means putting your money in all the components that are included in the index they track, and there are fund managers whose job is to make sure that the index fund performs the same as the index does. And now, let's take a look at the 7 reasons why new investors should look into investing in index funds right now. Number 1. They have lower fees. Index funds are passive investments with lower charges. Mostly because these funds are not handled by financial managers, it means there are no costly maintenance fees that detract you from your profits. And because index funds are set to track a particular stock market index, there's no need to pay for expertise, and therefore you don't need to pay a sales commission. Also, the cost of commissions and management of the account, known as expense ratios, is less than 0.5%, and some are even less than 0.2% per year, since they only trade when the composition of the underlying index changes. This further protects your investment performance. As Warren Buffett once said, most investors, both institutional and individual, will find the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results delivered by the great majority of investment professionals. Number 2. They minimize your risk. One of the top risks of entering the stock market is its volatility. This is something that most professional investors struggle with as they try to beat the market. It's just about impossible to predict the performance of the stock market from year to year and even quarter to quarter. Individual stocks may rise and fall, but the potential gains and losses of index funds are less volatile. So these funds are a good way to minimize risk because they track a market index that rises in value over time. With index funds, you might not get bull returns during a bear market, but you won't lose the cash either in a single investment that sinks when the market turns skyward. Number 3. They're tax-friendly. Anytime you sell a profitable stock, you have to pay taxes on that sale. That is, unless they're held in some sort of tax-free retirement account. Those taxes can take a real bite out of your returns if you're not careful. As there is generally very little buying and selling with index funds, they're less likely to generate taxable capital gains than actively managed funds that can add to your tax bill. This means index funds have favorable tax consequences, which enable your fund to grow without having to pay taxes, at least until the day you sell your position. Number 4. They help you build your investment portfolio. Since there are so many different sectors index funds are based on, you can create a portfolio based on your preferred industry, meaning it gives you a broader mix of industries and asset classes. Gaining access to a vast amount of market exposure can help you diversify your portfolio and reduce risk in a turbulent market much more than if you were to buy individual stocks. your profits are unlikely to be damaged much if one or two companies suffer major losses. And the wide number of available stocks will enable you to invest in both stocks and bonds, which is the main diversification goal for many investors. Plus, index funds are designed to rebalance periodically. In other words, funds have requirements governing which companies are allowed to remain in the portfolio. This is great for investors because it's a way of automatically reshuffling your investments without having to track any securities, sell off stock, and pay capital gains taxes. If this is not convincing enough for you to invest in index funds, then let's hear it from Warren Buffett, the Oracle of Omaha himself. Buffett says, "I believe that 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. That leads them to an index fund with very low costs." Number 5. They're better than actively managed portfolios. While actively managed mutual funds are typically well diversified, the research has shown that over the long run, they don't perform that well. In 2012, only 39% of actively managed funds performed better than their benchmark, a standard that a manager uses to measure their fund against, usually a stock market index like the S&P 500. This just shows that some actively managed funds might crush the market for a period, but in the long term, they'll unlikely underperform. And the reason is simple. It's hard to pick winning stocks and time the market right consistently, even for the professionals. Another research shows that from 2001 to 2016, more than 90% of active fund managers underperformed their benchmark index. So meeting market gains is a surer bet than beating the market. And that's just what index funds are designed to do. While you won't dramatically outperform the market with index funds, you won't dramatically underperform either, which means you get an average return. So when most actively managed funds underperform the market, being average puts you out on top. Number 6. They help you average the long-term growth. Index stocks are like the tortoise, having slow, steady growth over time. So there's a better likelihood that you'll see good returns on your investment than if you invested in high-risk, high-reward stocks. Therefore, another reason why you should invest in index funds is because they allow investors to participate in long-term growth potential of a particular stock market. Since your investments will be mirroring an index, it's natural that there will be ups and downs in the short term. That's why index funds are best suited for long-term financial goals. Plus, they are more cost-effective and profitable over a long period. It's a great investment option for those seeking to develop a strong retirement fund. The average annualized total return for the S&P 500 over the past 90 years has been 9.8%, although past performance is no guarantee of future results. Number 7. You don't have to know much about investing. Investing strategies can be deeply complex, but index funds have a "what you see is what you get" quality. They promise only to track the financial progress of the index to which they are tied. This means you won't have to spend any time researching individual stocks and evaluating which stocks might make the best investment. You won't be caught up with the short-term losses, and you'll also have the option to automatically reinvest your earnings month after month. But it is equally to ensure that the market you're investing in is a reliable one and has a history of long-term returns. To assess whether an index fund is a good investment, look at its long-term history stretching back to when the account first opened. And be sure to compare them to broader investing benchmarks so you can determine how they measure up in both up and down markets. Alright guys, those were the 7 reasons why you should invest in index funds. Thank you so much for watching the video. The key to being successful with index funds is to play the long game. Consistently invest in index funds even when the market sours, and in the long run, you'll just do alright. Let us know in the comments if you have invested in index funds or if you're considering doing so anytime soon. Please leave a thumbs up and share the video if you found it to be useful. For more videos on investing and personal finance, click on our channel and don't forget to subscribe. See you guys in the next one.